Call option selling looks like easy money until the market decides to humble you. Let's talk about call option selling, the bad, the good, as well as the risky. Hi, I am Pranav VK, an NISM certified trader and trainer and your options trading coach here at Stockshala by Kotak Securities. Last time we discussed about the buying side of the option contract. This time we're going to talk about the selling side of the call option contract. The world of option selling is where you earn the money upfront, but the risk is unlimited. When you sell a call option, you're actually giving another person the right to buy a stock from you at a fixed price and within a fixed time. In return, you get paid a premium upfront. But the only catch here is that if the price shoots up sharply, then you still have to sell that specific stock at the previously agreed price, even if it is way below the market price. So basically, it is limited reward to the extent of the premium that you receive upfront and unlimited risk potential. Let's take a real life analogy of a car rental to understand this better. Imagine you own a car rental space and you rent out your space for rupees 2000 a month. And whether this tenant uses the parking space or not, he ends up paying rupees 2000 every single month. But suddenly, what if this parking space becomes a part of a very huge mall which is world famous? And suddenly the prices of this rental space has shot up to almost rupees 1 lakh per month. But since you are the owner and also have a contract with the previous tenant for just rupees 2000 a month, you will continue to receive the same. So in this case, you are the option seller and the tenant is the option buyer. So he continues to pay you only rupees 2000 and not rupees 1 lakh, even though the price has shot up. And that is exactly how an option seller gets limited reward but unlimited risk potential. Let's take an example of a real stock to understand this concept better. Imagine the price of HUL is right now at rupees 2400. Now I want to do a call option selling and I'm going to choose a strike price of rupees 2450. Now imagine this to be the strike price 2450 and the actual price of HUL is 2400. By doing so, I receive a premium of rupees 25. Now there are two possibilities. One possibility is that the price of HUL might go above and beyond 2450. The second possibility is that it's going to remain the same or go below this. Now let's analyze both these scenarios and see how the profit and loss is going to look like. Now let's consider the first scenario where the price of HUL is going from 2400 to 2800. So in this case, the increase in premium is also almost going to be equivalent. So let's assume that the premium is going from rupees 25 to rupees 425. So let me increase that. Remember that as an option seller, you're doing short selling of the premium. So which means you sold it at 25 rupees and as and when the premium comes down, that is your equivalent profit. But if the premium shoots higher, then that is your equivalent loss. The higher the premium that it goes, that much is the loss you're going to be paying the option buyer. So in the first scenario, since the price shot up by 400 rupees, your total loss is going to be rupees 400 minus the premium that you received at the start. Now let's divide the second scenario into two parts. The first part is where the price of HUL remains the same. So let's put it back to 2400. So yeah, HUL remains at 2400. In this case, what is going to happen? The premium of rupees 25 comes down to 0 at the end of expiry, which means you are gaining a profit of rupees 25. Now moving on to the second part of the second scenario, the price of HUL has gone further down from 2400. Even in this scenario, the premium is going to go from rupees 25 to 0, which means you are going to make a profit even in this case, which is equivalent to the premium received, that is rupees 25 at the beginning. So as you can see, as a call option seller, you are winning 2 out of 3 scenarios, whereas as a call option buyer, you are winning only 1 out of 3 scenarios. This shows that as a call option seller, your probability of profit is 66%, whereas your loss potential is unlimited and your profit potential is limited to the premium that you receive at the beginning. Now that you have understood how call option selling works and its risk to reward, now let's understand why do traders actually do call option selling. There are few reasons. The first important reason is that it has high probability of profit. Number two, big institutions actually use these contracts to earn a yield on their capital. Number three, you can earn a consistent income when the market is flat or when the market is falling. But this strategy is not for beginners. It is for people who have strong risk management and have a clear understanding of option contracts. Now that we know the benefits of option selling, now we'll also understand the risks and warnings regarding call option selling. This is where most people underestimate risk. Risk in call option selling is literally unlimited. But one thing that I would like to share with you is that there is always a way to manage these risks. Just because the loss is unlimited doesn't mean that you're always going to lose a lot of money. There are ways for you to put stop losses and also do hedging so that you can limit your losses. These are the concepts we will understand in depth in the upcoming videos. But with that being said, it is very important for you to learn how to manage the risks, otherwise the risk is unlimited. Sudden news or any political events can cause huge volatility and your losses can be humongous. And if you don't have enough capital, then you will not be able to enter into a option selling contract. But in case you do, and after which if your margins are lesser than what is required, then remember that your broker might square off your positions. So here are my top 3 tips. Don't try this with small capital. Don't do this without proper stop loss or hedge. And finally, definitely don't do this just because some Telegram channel told you option selling equals income. Here's an important fact. About 85 to 90% of option buyers lose money in the markets. That doesn't mean option sellers are always making money. One big move can wipe out years or even months worth of profit. So let's do a quick recap of what we have learned so far. Selling a call option basically means you are bearish on the underlying stock or you expect the market to be flat. When you sell a call option, you are earning a premium and you're giving up on the upside. The probability of profit is 66% as an option seller, and as an option buyer, it is only 33%. Whereas when it comes to profit potential, as a call option seller, you are only having limited reward and unlimited risk potential. Though theoretically you have an unlimited risk potential, it is possible for you to make it limited risk using hedging techniques or using stop losses. Now, since we have these options of managing your risk in option selling and also having a high probability of profit, it is always better to seek out to do option selling compared to option buying. Now, if you understood call option buying and call option selling in the most simplified manner, then make sure you're going to stay tuned because in the upcoming videos, we're going to cover put option buying and put option selling as well. And remember, don't trade until you understand all these concepts very clearly. If you like this video, go ahead and share it with your friends. Subscribe to the channel, and you're watching Stock Shala by Kotak Securities. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.